Okay, let's jump right in. Welcome to the Explainer. Today, we aren't just taking a casual glance at a stock, we're putting it through an absolute gauntlet. We're going to step into the shoes of expert investment analysts and dissect a specific company using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Our subject for this ultimate stress test, a company called Alto Ingredients.
Here is the exact game plan. We'll start with a quick snapshot of the business. Then we'll apply the Buffett, Lynch, and Graham lenses. After that, we're going to run the hard quantitative models with a discounted cash flow and comparable multiples analysis. Finally, we'll synthesize the whole shebang into a final verdict. Let's get to it.
Section 1, the company snapshot. Before we can value the business, we actually need to know what it does, right? So we are looking at Alto Ingredients. Their ticker is ALTO, currently trading at $5.56 a share, sitting at a market cap of just over $430 million. They operate in the specialty chemical and alcohol space, which, let me tell you, is a highly dynamic market. Essentially, their business is tied to commodity cycles. They take raw corn and turn it into everything from renewable fuel like ethanol to specialty ingredients. Over the trailing 12 months, they generated over $916 million in revenue. Now, what's super interesting is they are currently in the middle of a major strategic realignment. They're pivoting toward higher margin essential ingredients. Think corn oil, yeast, protein, and backing that up with a $25 million Section 2, the Warren Buffett lens. Let's see if this business survives the Oracle of Omaha's strict criteria. Because, Buffett doesn't just buy stocks, he buys entire businesses. Buffett is hunting for dominant businesses. He wants predictable cash flows, high returns on equity, manageable debt, and most crucially, an economic moat. He wants a durable competitive advantage that keeps rivals completely locked out. Oh, and he demands a strict margin of safety. So how does Alto stack up? Well, they do have an acceptable 12.1% return on equity. They're also aggressively paying down debt, currently sitting at a very manageable $73 million in long-term debt against $249 million in equity. And their proxy owner earnings, their true cash flow, is positive at around $39 million. But here's the catch. Because they operate in a commodity market, their economic moat is basically non-existent. Their earnings are highly cyclical, swinging from losses to a $4 million profit recently. For Buffett, the lack of consistency and that weak moat means he's probably walking away. Or at the very least, he'd demand a massive margin of safety. We're talking waiting for a sub-$4 price tag to even give it a second look. All right, Section 3, the Peter Lynch lens. Lynch was famous for finding hidden gems by really understanding the underlying story of a company. Lynch sorted stocks into 6 specific buckets: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. So where exactly does Alto fit? Given their heavy reliance on wildly fluctuating corn crush margins, but paired with their strategic push into high-margin ingredients, this is a textbook cyclical with some serious turnaround energy. Management is actively trying to break free from that seasonal weakness. And to measure the valuation, we use the famous Lynch PEG ratio. If we take their implied price-to-earnings ratio of 15.4 and divide it by their historical earnings growth of 10.56%, we get 1.46. Now, Lynch loved a PEG ratio under 1.0 for a strong buy, so 1.46 is a bit elevated. However, Alto has a massive 10.6% insider ownership. Management has some serious skin in the game, which Lynch absolutely loved. All things considered, Lynch would likely rate this a hold, keeping a very close eye on how that turnaround story develops. Let's move to Section 4, the Benjamin Graham lens, the undisputed father of value investing. For Graham, it's all about extreme downside protection. If we run Alto through Graham's defensive investor checklist, it's honestly a mixed bag. They easily pass on size with that $430 million market cap, and they pass on financial condition thanks to their shrinking debt. But they instantly fail on earnings stability due to historical losses, and they fail again because they pay 0 dividends. Graham despised unpredictability. He was obsessed with protecting capital at all costs. But let's actually force the math using his legendary intrinsic value formula. We take the standard 22.5 multiplier, multiply that by their trailing earnings per share of 36 cents, and then multiply that by their book value per share of about $3.22. We take the square root of that whole thing to find the absolute floor value of the business. That formula spits out a Graham value of $5.11. This is fascinating because at the current price of $5.56, Graham would look at this and say there is absolutely zero margin of safety here. To hit his strict 30% margin of safety rule, this stock would need to drop well into the $3 range for him to even consider buying. Let's shift gears for Section 5, DCF and multiple valuations. We're stepping away from the gurus for a minute to run the hard, quantitative models that institutional analysts use. To build our base case discounted cash flow model, we have to make some educated assumptions. Let's take their $64 million in trailing EBITDA and subtract their stated $25 million capex budget for 2026. That gives us a proxy free cash flow of roughly $39 million. We'll use a 10% weighted average cost of capital, a solid discount rate for small cap cyclical risk, and we'll slap on a very conservative 2% perpetual growth rate for the terminal value.
Check out this sensitivity matrix. A DCF is only as good as the numbers you feed it. But even when we stress test this, bumping the discount rate to 11% or dropping growth to 1%, the model keeps pointing to a fair value range heavily anchored around $8.50 per share. Quantitatively speaking, this suggests severe fundamental undervaluation right now.
And that's not all. When we look at comparable multiples, Alto is trading at a massive discount compared to its peers. Their price-to-sales ratio is incredibly low at 0.39. That means you're literally paying just 39 cents for every single dollar of sales they make. Compare that to Green Plains at 0.53 or MGP Ingredients at 0.70. Alto is generating way more revenue per dollar of market cap than its direct rivals. All right, Section 6, Synthesis and Final Verdict. We've run the gauntlet. Now let's look at the scoreboard and figure out what it all means. When we line up every framework, the divide is super clear. Benjamin Graham is completely out. He demands you wait for a sub $5 price. Peter Lynch is telling you to hold and watch to see if that essential ingredients pivot actually works out. But then, the DCF model and the Wall Street analyst consensus are screaming buy, seeing massive upside potential with targets in the $8.50 to $9 range. Visually, this spread is pretty striking. The current price of $5.56 is basically hugging that absolute worst-case Graham floor. So your downside risk appears fairly capped by their shrinking debt and solid book value. But on the flip side, if management executes their turnaround plan, the quants are pointing to a massive 50 to 60% runway of upside. So what's the final verdict? With 10% insider ownership and shrinking debt going head-to-head against extreme commodity cyclicality, Alto is a calculated risk for the value-conscious investor. If you believe management can pull off this turnaround, the math says the stock is deeply discounted. But if they stumble, that commodity risk is going to bite hard. So I'll leave you with this question. Is Alto the misunderstood value play of the year, or just a value trap waiting to spring? You decide.